If only we had a crystal ball, but where do you put your recession risk fears at the moment? Are you more worried for this region about a US recession or a slower recovery in China and a recession there?
I would say at this stage we're probably concerned with. There are two parts here. Obviously, for the lockdowns in China to be prolonged, or rather a recovery from that, those lockdowns to be choppier than expected. That's going to be a bit of a drag to the names, some of the names we cover in the region. Of course, U.S. recession risks are still there. I think that would obviously have impact on the global sector. So even if we do get some China recovery in 2023, which could be a buffer for this region, it's not going to offset a U.S. or global recession in that sense.
Where then do you see opportunities, and what is your approach at the moment given all of the uncertainties?
At this stage, we are actually seeing the best value in terms of our fair value estimates, in terms of the discount to fair values, through the beaten down sectors, which are technology and consumer discretionary. So we will look through the cycle, which we tend to do at Morningstar, and look for, for any investors looking for a 3-year time horizon. There are opportunities selectively within the technology and consumer discretionary sectors. So these are probably where we would be most favorable on. There are some very high quality companies with strong cash flows. So that's probably where my immediate preference is. But, it's going to be a little bit choppy over the next few months still because of headline risks. So I think there's still room for some defensive plays, and ST Engineering, for example, would be a company that we like because of stable dividends, decent dividend yield, and some recovery from airline travel.
Dividends are getting very popular all over the world, aren't they, Lorraine? I want to ask you about Japan. We had a story in the last 24 hours on Bloomberg that the bearish bets by hedge funds against Japan's Nikkei are at their most in 4 years. This is interesting to me because there seems to also be a lot of people who are fairly bullish on Japan, maybe a little bit more over the medium and longer term. Where do you come down?
Actually, we do. There are pockets of companies that we do like in Japan. I think that this comes down with the fact that technology names and some industrial-related names have been sold down, and therefore we think there's opportunities. One of our, favorite stories over the medium to long term are the industrial robotics because of demographics, because of the COVID experience. A lot of people will be shifting more, I think, to try to increase their use of robotics. So that those names in those segments, including Harmonic Drive Systems, Fanuc, Yaskawa, would be stocks that we still like.
Broadly speaking, there's a lot of other Asia region countries to look at. I've seen some big movements in Aussie stocks recently. Last year, Korean stocks were on a tear. If you have to pick another, country equity market to look at, who is it? What is it?
We probably will have a look at Korea, but again, we're potentially not looking at the market as a whole. I mean, that would be the case for all the countries that we're looking at. And we just like particular pockets of names. One of the segments in Korea that we do like would be the banks.
All right. Quickly then throw me just not Australia?
Australia's a little bit out of my jurisdiction, but there are selective names that we like in Australia as well. We'd be a little bit wary of the energy and commodities space right now because we do see these elevated prices as being not a price level that can be sustained in terms of market dynamics, in terms of mid to long term supply demand balance. So that's our immediate concern there. We think that a lot of the good news is factored into the energy, the upstream energy plays right now.
Lorraine, China has been such a popular inflation hedge and in a hedge from all of the uncertainty we see elsewhere. But how far along are we in this rebound? Are we getting to the point where we're starting to see a lot of the low-hanging fruit being taken up now?
Actually, I see China as, I would still see it as there's certain sectors that there's still room. Obviously, the the big e-commerce names were sold down significantly, first on regulatory risk and obviously in the slowdown. We do think top-line growth is going to slow to high single digits over the next 5 years for most of these companies. But we think that their share price falls reflect that. And we do see a more friendly or slightly more supportive regulatory environment going forward in China. So, but these are still names that are trading around half of their fair value estimates. So we're talking names, big names like Tencent, Alibaba, JD.com, probably about 40% discount. So we still like those as well as an opportunity.